talk out this morning about what we had sort of anticipated, but now beginning to sort of clarify it and crystallize a bit. This blowback from the bank failures collectively earlier this year is now beginning to manifest in terms of regulatory scrutiny and proposals. Not surprisingly, the calls are for tighter regulation, not looser, in the form of higher capital requirements. What is strange, at least in my mind, is sort of how the regulators seem to be approaching this. And to be clear, none of this is yet set in stone, but early indications are that banks could face significantly higher capital requirements. And it seems to be really in two sort of veins. One is on the fee-based side of the business, right? So banks earn money really two ways. One is on an interest spread, and the other is through fee-based activities. So things like wealth management, trading, credit card fees, et cetera, et cetera. And then, it would seem like the real problems from earlier this year were born out of, asset liability mismatch from a duration standpoint. So poor management on that front. You would think that the regulatory sort of response would be aimed more squarely in that direction, but it would seem that it's very not that case. It seems that they're going after fee businesses. And so the more exposed to fee-based income banks are, it seems the more heavily they'll be penalized. So this is going to have a number, if this actually happens this way, it's going to have a number of interesting ramifications. The other thing regulators seem to be targeting, which also is kind of interesting, is the big banks. So rather than sort of squarely aiming the bazooka right at the middle market, these sort of mid-sized regionals, which is obviously where the sort of bolus or concentration of the problems was, it seems that the larger banks are actually going to be under greater pressure as a result of this, which you can make some interesting arguments as to why that doesn't make a lot of sense. But anyway, that seems to be the direction they're going. So ultimately, as we expected, this is just going to drive the cost of doing business higher for banks overall. It is going to sort of, it seems, disproportionately target those with heavy fee income, and the further up the curve you are in terms of size, the more negative it's going to be. So we've already got this acceleration in, if you will, the deceleration in loan growth slowing. And now you've got the regulators sort of tightening the screws further, which is, what they normally do in reaction to crises. So.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.